According to the Motley Fool, Americans have to work 114 days into the year just to afford their tax bill. I want to share with you exactly how you can cut that in half by investing in real estate. With investing in real estate, there's so many tax benefits that not a lot of people talk about, and I'm going to be sharing with you here in this video. Before I begin, I'm not a tax expert and I'm not a tax professional. I'm just sharing with you some of my real life examples of what you can write off with your taxes that I have actually talked to my accountant so I can write off these taxes. So let's jump into it right now. The very first thing is property taxes. The taxes that you have to pay every single year and that come out of an escrow account every single month, you're going to be able to write off those property taxes. Now, the next thing is obviously going to be your insurance. You can actually write off, again, whenever you're paying your monthly mortgage, a portion of that is in an escrow account, and the insurance company are actually pulling money from that escrow account. And so that money you can actually write off on your taxes. Again, seek professional help because there might even be a percentage that you can only write off on your insurance. Okay, the next thing is interest. Well, interest is a huge deal whenever it comes to investing in real estate. And why is that? Because for the first, I think it's like 17 or 18 years, whenever you're paying on a mortgage, most of your payments are actually going towards interest. So interest is actually such a big deal because if you think about it, the first 16, 17, 18 years you're paying on that mortgage, a lot of it, over half of it is going towards interest. And so if you can actually write off that interest every single year, that's a huge deal. Let's say you make $6,000 a year in cash flow. Well, you paid $7,000 in interest. Well, you can write off all that $6,000 in cash flow because you've exceeded that with your mortgage interest, not including everything else. And you can write off all that and don't have to pay any taxes on it. These are three very commonly talked about tax deductions that you can get from investing in real estate. Now I want to get into some things that not a lot of people talk about. So let's get into the next one. Next one is property management fees. So if you hire out a company to run your property management, run everything, dealing with the tenants, etc., you can write off the property management fees off your tax bill whenever it comes time to pay your taxes in January to April. So the next thing is actually your repairs and your improvements. So if you make any type of renovations to your home or your house, your rental property, whatever, you can write off those repairs. Another crazy one is it's actually advertising costs. I think now Zillow you have to pay to advertising your rental property on Zillow, and you can actually deduct those advertising costs. If you put your property on other websites that actually charge you a monthly payment or a one-time fee for actually advertising on their website, then you can write off those advertising costs. So whenever you're investing in real estate, after about the second or third property, it's very important that you get an LLC so you protect yourself from, you separate your personal assets from your business assets. So if you actually form that LLC, you can actually get additional tax benefits. And here are some few. There are marketing costs. If you send out direct mailers to actually acquire some real estate, you can write that off. The next thing is actually legal and professional fees. So actually the legal fees that you pay the lawyer to form your LLC, you can actually write off those legal fees, as well as an accountant, as well as a bookkeeper, a virtual assistant, any type of those things that you're paying for, professional fees that you acquire whenever you're owning real estate and you actually get to a point where you're actually building a team. Now, the next thing is business equipment. So if you ever get audited, you're going to have to prove all of this stuff. So business equipment can be a little, it's a weird spot, but you can write this off because if you buy a laptop and you're using it specifically for your business purposes, first of all, you have to prove that if you ever get audited by the IRS. These are just some ways that you can actually reduce your tax bill. And I'm just giving this information to you, but just be aware that if you actually do get audited, you have to prove all of this stuff. So the next thing is actually an office space. And I've talked about this before in a previous video, it's a percentage based off of the square footage of your house, or you can do a simple formula, which is, $5 per square foot up to 300 square feet. So if your office space like mine is about 200 square feet, you can get between $1,000 to $1,500 off of your tax bill at the end of the year. So the next thing is actually going to be communication, internet, cell phone bills, stuff like that you can write off. But you might only be able to write off a percentage of this, because if you actually have this internet and your cell phone plan attached to your personal stuff, like your home or other sorts of things like that, then you're going to have to prove that you're using it for business, and you might only be able to write off a percentage of it because you're using it for personal use as well. So the next thing is actually going to be travel expenses. This is one thing that I think Kevin actually did about a year ago, before the shutdown, before the pandemic, is he went on a cruise from real estate, and he didn't pay anything for it, because so whenever he created his S Corp in a nutshell is basically you spend all the money you make, and if you spend all of it before the tax season, before your tax bill comes, you don't have to pay taxes on that. Meaning that if you make $100,000 in real estate and you have an S Corp, you spend $100,000 on expenses, like for your business, you don't have to pay any taxes on the $100,000 that you made, because whatever tax law it is, again, I'm not a tax professional, so I don't necessarily know that, but I do know that you can deduct your travel expenses. He actually went on a cruise, and because of his S Corp, he spent that money on travel expenses for business, and he got that written off, and he went on it for free. But other travel expenses being vehicle mileage and parking fees, etc., stuff like that. So literally keep all your receipts whenever you are owning a business and investing in real estate. So the next thing is actually going to be education. You can write off, books, courses, all this different types of stuff that you are acquiring for your real estate business in the form of education. So if you invest a course for $500, you can write off that $500 on your tax bill as an education expense. So the very next thing is actually going to be meals. So if you are if you're taking a prospective client out for dinner, you can actually write off that entire dinner on your tax bill. If you didn't know some of those write-offs, hit that like button. Another big tax write-off is actually depreciation. Depreciation is basically just a method that you can deduct the loss of the value of the property over 27 and a half years. So for example, if you have a property that is worth $200,000, all you do is divide that by 27 and a half years, and then you're going to get you can write off $7,272 every single year that you own that property. Now, there's a catch. Whenever you go to sell this property, this depreciation is actually captured. So the money that you are writing off at the end of the year in the form of depreciation, they're going to take that money back. There's actually a way to get around this, but we're going to talk about it in just a second. So the next tax benefit is actually going to deduct your capital expenses. And what does that mean? That means your HVAC, your roof, any high ticket items like this, you can write those off. Again, this kind of goes into the point of improvements and repairs. So here is the catch whenever it comes to depreciation. Again, whenever you depreciate it, they will be capturing that depreciation whenever you do sell that property. Well, here is how you get around that. You use a 1031 exchange. What is that? I actually have a video about that, but I'm going to touch on it really quick. A 1031 exchange is basically where you roll the capital gains from a property into a like-kind real property. Meaning, if you have a single-family home, you sell it, you take those profits, you move it into another single-family home or land or a business or anything like this that's real property. Now, I'm going to leave a link up here to watch that video because I go really in depth with the 1031 exchange. So I mentioned capital gains. So actually, whenever you go to sell a property, the profit that you make, it's known as a capital gain, and so you have to pay taxes on that. Well, actually, if it's a short-term capital gain, you're going to pay about 10% to 37% depending on your tax bracket. That means the profit that you make from the property and your income for the entire year, either that be strictly investing in real estate full-time or you have a day job or etc. That will depend on how much tax you're going to pay whenever you sell that property for a short-term capital gains tax. Now, there's actually a long-term capital gains tax. And if you hold that property for over a year, you're going to pay 0 to 20% depending on your tax bracket. So how do you get to 0% long-term capital gains? Well, if you live in a property for the last 2 to 5 years as a first-time home buyer, you don't have to pay any taxes whenever it comes to selling your property after the 2-year mark. So say you live in the property for the first year, then you move and you move for the 2 years, and you move back in the property for another year. Well, now if you decide to sell a property, you don't have to pay any capital gains on that property, the profit of that sale. And again, you can use a 1031 exchange to actually negate these capital gains, because like we said, a 1031 exchange is just a way to avoid capital gains tax, avoid depreciation, avoid a bunch of things that you have to pay whenever you sell a property. There's going to be videos popping up all right here. So I picked them out specifically for you, and I really think you're going to enjoy them. So until the next video, I'm out. See ya.